Welcome to the Explainer. So if you've ever looked at a financial chart and felt like you were staring at just pure unpredictable chaos, well, you are in the exact right place. Today, we're talking about price action. And honestly, it's the ultimate way to demystify those chaotic charts. You know, professional traders, they don't rely on a messy web of complicated indicators to tell them what to do. They definitely don't guess. Instead, they just read what price itself is telling them. I absolutely love this quote right here because it perfectly frames what we're doing today. Think of this explainer as a lesson in learning a completely new language. Literally, the language of price. Every candlestick tells a story, and every single high and low reveals vital information about the ongoing battle between buyers and sellers. By actually studying these movements, we can start to predict where price is most likely to go next. Okay, let's just quickly look at our roadmap for today. We've got a really simple progressive structure, starting with the language of price, moving into time and trends, decoding market structure, and finally, mapping support and resistance. All right, part one, the language of price. Let's get right into reading candlesticks.
So candlesticks are the absolute smallest unit of information on a chart, and every candle has four critical prices: the open, the high, the low, and the close. Together, these four data points tell the complete story of a specific trading period. That thick part, that's called the body, and that is strictly the distance between the opening and closing prices. Then you have those thin lines sticking out above and below. Think of those wicks kind of like footprints left behind in a battle. They show you the absolute highest and lowest prices reached before the market retreated.
And this really brilliantly illustrates the visual outcome of that trading period. It makes it incredibly simple to tell who actually won the session. A bullish candle means the closing price is higher than the opening price, so buyers won. A bearish candle means the closing price is lower than the opening price, meaning sellers won. It really is that straightforward. Moving right along to part two, time and trends. Let's find our market direction. Now we're going to zoom out a bit to look at the broader sentences formed by price. A time frame simply tells you how much time each candlestick represents. And here's the little secret that frustrates so many novice traders. Lower time frames, like the 1-minute chart, are honestly like watching a squirrel on espresso. I mean, it's full of detail, but it's completely chaotic market noise. Higher time frames, on the other hand, show the bigger picture. They offer a much more reliable overall market direction. The pros will almost always analyze these multiple time frames before they ever make a decision. So once you've got your time frame set, you need to find the trend. The trend is just the overall direction of the market. And there are only three possibilities here: an uptrend, a downtrend, or a sideways market. Figuring out this trend is literally the most crucial step, because it directly dictates whether buying or selling has the absolute highest probability of success.
But hey, I do need to give you a quick warning about that third direction. A sideways or ranging market happens when price just bounces back and forth between two levels. During these periods, buyers and sellers are, relatively balanced. You really must recognize when the market is consolidating like this. Why? Because so many standard trend-following strategies will just completely fail during this sideways action.
Okay, part three, decoding market structure. Let's talk about highs and lows. Now it's time to put on your detective hats. Professional traders don't just stare at individual candles. They study exactly how highs and lows are formed. A swing high is a peak where price stops rising and begins moving downward, basically showing that sellers gained enough strength to push the market lower. A swing low is the exact opposite. It's a bottom where buyers stepped in to push price upward. The crucial point here is that these turning points leave historical clues about who is currently in control of the whole market. All right, let's really slow down and focus in on this next concept, because it's absolutely crucial. A break of structure, or BOS. This happens when price breaks an important swing high or swing low. Now, why does this matter so much? Because a BOS confirms that the existing trend is continuing. If an uptrend creates a new higher high by breaking the previous swing high, well, that bullish break of structure proves the current trend still has serious strength behind it. But what happens when that strength starts to fail? And that brings us to a change of character, or COCH. You can contrast this directly with the break of structure we just talked about. If price suddenly breaks below a significant higher low and an uptrend, that is your detective's first critical warning. It signals that buyers are losing control and sellers might be taking over. Now, a COCH doesn't guarantee a reversal is happening right that exact second, but it definitely alerts you to sit up, pay close attention, and watch for one.
Which leads us to part 4, mapping support and resistance. Let's look at our market levels.
This is where we tie all these structural concepts together into actual, actionable zones. Think of support as the floor. It's a price level where buying pressure has historically been strong enough to literally stop the market from falling. Resistance is the exact opposite. It's the ceiling, a level where selling pressure repeatedly stops the market from moving any higher. But keep this in the back of your mind. While these floors and ceilings cause very real reactions, they are definitely not unbreakable. If buying or selling pressure becomes strong enough, price is going to smash right through them.
You should also know that support and resistance don't always stay perfectly horizontal, though. Sometimes they're dynamic. Things like trend lines, moving averages, and rising or falling channels. They adjust as the market trends upward or downward. They actively move with the market, giving traders these constantly updating areas to watch for potential reactions.
All right, let's pull all of this together into a clear professional strategy. First, you read the candlesticks to see how price is moving. Second, you determine your timeframes and find that overarching market trend. Third, you identify the market structure by spotting your swing highs, breaks of structure, and changes of character. And finally, you map out your support and resistance zones to find where price will most likely react. Mastering these interconnected steps gives you a remarkably strong foundation for reading almost any chart with total confidence.
So, you've got the foundational language down and you know how to read the structure. But are you ready to spot the morning star? Or what about an engulfing candle? Once you have this underlying structure figured out, those specific patterns become really powerful keys to unlocking the market's next move. Thanks for joining this explainer. Keep studying those charts and ask yourself, what story is your next candlestick gonna tell?